Picture this. You have a neighbor. Let's call him Gary. Gary just took out a massive multi-million-dollar second mortgage on his house. But Gary didn't use that borrowed money to fix his leaking roof. He didn't use it to pay off his maxed-out credit cards. And he definitely didn't use it to start a business. Instead, Gary took that borrowed cash, marched straight down to the jewelry store, and bought himself a solid gold Rolex. Why? Just so everyone else on the block thinks he finally got that big promotion at work. You look at Gary and you think, that sounds absolutely insane. That is a fast track to personal bankruptcy. Well, congratulations, you just figured out the fundamental underlying playbook of modern corporate America. Today, I'm going to show you exactly how the most powerful CEOs in this country are quietly borrowing billions of dollars in cheap debt to artificially pump up their own stock prices. They are leaving their actual companies completely hollowed out, incredibly fragile, and practically begging for the next multi-billion-dollar government taxpayer bailout. By the end of this video, I promise to prove to you that the rosy, optimistic story you are being fed by the mainstream financial media right now is completely wrong. We're looking at a systemic, debt-fueled corporate collapse, and it is entirely by design. But before we dive into the terrifying underlying data and the complex math of how this scam actually works, we need to rewind. We need to look at how American business was actually supposed to function, because we have entirely lost the plot. There used to be this wild, old-school concept in finance. A company would manufacture a great product, sell it to consumers, make a profit, and then, here's the crazy part, actually reinvest that profit back into the business. They would build new factories in Ohio, they would hire better engineers, or they would massively boost their research and development budgets to invent groundbreaking new things. That was genuine economic growth. That was how you built a fortress of a balance sheet that could survive an inevitable recession. In fact, prior to 1982, the core mechanism we are talking about today, the stock buyback, was largely considered illegal. The SEC viewed it as blatant market manipulation. If you were a CEO and used company cash to buy up your own stock to make the price go up, you were risking federal charges. But then the rules changed. The SEC introduced a safe harbor rule, basically legalizing the practice. And ever since then, it has been a slow, insidious creep toward the financialization of everything. Now, let's fast forward and contrast that history with what you see today. If you turn on CNBC or open any major financial newspaper, the mainstream anchors are practically doing backflips celebrating these massive corporations for having strong earnings per share. They are desperate for you to believe that the economy looks great and the stock market is an unbreakable fortress. But when you look under the surface, the reality is absolutely terrifying. These companies are not growing because they are innovating. They're operating exactly like a guy going through a midlife crisis who is trying to fund his entire luxury lifestyle using 5 maxed-out credit cards. The traditional media ignores these systemic financial issues because they require actual nuance, and they don't generate easy clickbait headlines. But the truth is, we have completely replaced genuine economic innovation with pure, unadulterated financial engineering. Let's take a deep dive into the actual mechanics of this illusion of value. I want to translate this Wall Street jargon for you so you can see exactly how the sausage is made. Let's say you are the CEO of a massive Fortune 500 company. Let's call it Omnicorp. Your multi-million-dollar performance bonus, the money that buys your third yacht and funds your private jet habit, is tied directly to one specific metric, making your company's stock price go up. Now, as the CEO, you have 2 choices. You could spend the next 10 years doing the grueling, incredibly risky work of developing a revolutionary new product. You could invest in your workforce. You could update your aging software systems. But that takes time, it takes effort, and frankly, it might fail. Or you could take the easy way out. You could go to Wall Street, borrow $1 billion of incredibly cheap debt, and use that borrowed cash to literally buy up Omnicorp's shares on the open market. Here is the magic trick of stock buybacks. When a company buys its own shares and retires them, it reduces the total number of shares that exist in the world. So even if Omnicorp didn't sell a single extra product this year, and even if their actual revenue stayed exactly the same or even declined, their earnings per share magically skyrocket. Why? Because the pie is now divided into fewer slices. The algorithm sees the EPS go up, the stock price moons, Wall Street treats you like an absolute visionary genius, and you cash out your massive bonus. You get to go on CNBC and talk about your brilliant capital allocation strategy. But what actually happened to the company you were supposed to be running? The R&D budget got completely gutted because you spent all your cash buying your own stock. The corporate balance sheet, which used to be rock solid, is now incredibly fragile and carrying a towering mountain of debt. The guys in the $1,000 suits love to look down their noses at the broccoli-haired teenagers who are gambling on dog-themed meme coins and Discord servers all day. They mock the retail traders. But what corporate America is doing right now is basically the exact same thing. They are using the greater fool theory to pump their own bags. It is the exact same energy as a crypto bro in a Tinder date who aggressively calls himself a serial entrepreneur, but you find out 20 minutes into the date that he actually just sells solar door to door. It is all a facade. It is the ultimate illusion of value. You have these Fortune 500 CEOs waking up at 4 a.m. listening to David Goggins podcasts, completely convinced they are apex predators of business, while literally bankrupting a 100-year-old American brand just to hit a quarterly target. For the last decade, this scheme worked flawlessly. Why? Because we were in an unprecedented era of free money. Following the 2008 financial crisis, interest rates were forced down to practically zero. Borrowing $1 billion to pump your stock cost next to nothing. It was essentially free leverage. But this brings us to the most critical part of this entire situation, a concept we talk about on this channel a lot: the gambler's ruin. We all know the era of free money is violently ending. We have watched inflation spike, and we have watched the Federal Reserve hike interest rates at a historic pace. The cost of borrowing has exploded. So let's zoom out to the million-dollar macroeconomic question. What exactly happens when the cheap debt finally runs out? Think about the math here. Over the next 3 to 5 years, trillions of dollars of this corporate debt is going to mature. The bill is coming due. When Omnicorp borrowed that $1 billion to buy back their stock, they were paying maybe 2% or 3% interest. When they have to refinance that exact same debt next year, they're going to be looking at 7%, 8%, maybe even 9% interest. Their debt servicing costs are going to double or triple overnight. But remember, they didn't use that borrowed money to build a new factory that generates revenue. They just bought their own stock at the absolute top of the market. They have no new cash flow to pay for this newly expensive debt. When the music finally stops, who do you think is going to be left footing the bill? Spoiler alert, it is not going to be the CEO. That guy already cashed out his stock options, bought a compound in New Zealand, and is waiting for GTA 6 to drop. The people who are going to pay for this are the thousands of workers who will inevitably be laid off to cut costs. The people who are going to pay are the everyday retail investors whose retirement accounts are stuffed with these hollowed-out index funds. And ultimately, when these massive corporate loans start coming due, they aren't going to accept defeat. They are going to run crying to Capitol Hill, claiming they are too big to fail, and demand another massive taxpayer-funded bailout. They are quietly committing corporate suicide, and they fully expect you to pay for the funeral. This is the systemic danger that nobody on traditional television wants to talk about. We have built an entire economy on the back of financial engineering rather than actual engineering. We have incentivized executives to cannibalize their own companies for short-term gain, and we've normalized it to the point where it's just considered standard business practice. I want to hear from you guys on this one, because the macroeconomic impact of this debt wall is going to affect all of us. When these massive corporate loans start coming due, are we looking at an inevitable slow-motion corporate collapse? Or is the government just going to fire up the money printers and bail them all out again? Drop your take in the comments below. I read every single one of them. Make sure you hit subscribe so you can actually stay ahead of the narrative instead of just reacting to it when the mainstream media finally figures it out, and I'll see you in the next one.